I get it, you're in your 20s and 30s, the whole world is exciting. Why should you even care about your super? Well, it's not just a tool for living the retirement of your dreams. It can actually help you reduce the amount of tax you pay and help you buy your first home. Now, from the outset, it's important to note that most Australians will be contributing to their super throughout their working life. And that money is your money, so it's actually a really good idea to get across it and understand how it works. Which brings me very neatly to Mazin Albassit, the perfect person to get this kind of information from. He's a financial advisor at BG Private, and he helps hundreds of people understand and make the most of their super every day. I'm going to get him to give us 5 top tips on how we can get the most out of our super. Maz, hello, welcome in.
Hello, thank you for having me.
Great to have you in here. I know the studio is a little different to the environment that you normally work in. Fewer spreadsheets, fewer...
Yeah, there's definitely a few less spreadsheets here, but that's all right. We can make do.
We can load some up. Do you have fax machines still where you work?
Actually we do.
See?
Because it's actually the most secure form of communication, so...
Oh my God.
Yeah. Centrelink still uses faxes.
Tip number 6. Okay, let's dive in. So I guess the first one is, Maz, why should I care about my super?
You know what? I really appreciate you asking me this. It's like we scripted the first question. It's not every day that I get to talk about superannuation and explain to people why I'm so excited about it. And hopefully by the end of this, you understand why. I think tip number 1 is your superannuation is going to be the biggest asset that you hold, or at least one of the biggest assets you hold. It could be your home, could be your super. I think that's
on that kind of a level.
Massive. We're talking trillions. Currently, there's $3.5 trillion in super.
$3.5 trillion in super. Okay, that's a lot. How long has super been a thing in Australia?
It's interesting because Australia's had a long love affair with super, and we may not know this. I personally am a bit of I wouldn't say I'm a history buff, but I love to understand where something's come from because that really helps me get the why. And when I get the why, then I start to care about it. So maybe if I take us back through the history, right? Australia was one of the first countries in the world to have a form of superannuation. It was back in actually 1857, we created our first staff kind of super plan. And in 1885, we created the first staff pension plan, right? So in the world.
Wow. Okay, so we were the first to it.
We're the first to it. So some pretty smart people sat down and said, hey, we need to start planning for this thing called retirement. So they created these pension plans. Now, it's not exactly the same. So fast forward to 1993, we were considered world's best practice, gold standard in terms of superannuation. Let's focus on, the current and what we currently have. And again, I'll just go back to the why. Why was it formed? So a little while ago, our government realised they had a problem. They had this massive generation coming through, the baby boomers, and they realised that, hey, we can't support all these people on welfare, basically what we call Centrelink or Social Security as you see on the TV shows, right? But we can't support everyone coming through on Centrelink. So we need to create something that's going to work. So they set a task out and they did a white paper and they basically did some research and they said, okay, we're going to create a 3-pillar system in this country. Pillar number 1 is around home ownership and voluntary contribution. So the ability to own your own home, have your own savings and do all those things, right? So that was pillar number 1. So that was a really important part. Pillar number 2 was shoring up the Centrelink system, so making it a means-tested system. So not just everyone gets welfare when they retire. It's based on your income and assets, right? And a few other factors. And pillar number 3 is my favourite, superannuation, right? So they're like, let's create something. There was a few things around, like I said, some few things had sort of evolved to these things. And what they did is they went and they said, okay, let's get superannuation and let's give everyone a favourable tax rate if they put money aside for their retirement. That's all superannuation is. It's just your money taxed differently. You're making an agreement with the government. You're saying, okay, if I put this money in here, you're going to give me a discount on my tax. And the government goes, sure, let's do it, right? And it's a really powerful, favourable tax rate. So that is where super came from. It's from the past when they realised, hey, we got this problem and we're going to create this system that everyone can use.
Now, apparently, you were telling me before we started recording that Australia is one of the best in the world still. Like, we're ranked in the top 5?
Yes, we're
somewhere?
number 5. Yeah. So Mercer's CFA Institute Global Pension Index. So every year they look at all the pension strategies around the world. And we're number 5. Unfortunately, we missed out on the top spot, which was Norway. But I can say that we do go up and down. So I think our superannuation system is something we should really be proud of. And unfortunately, when you look at other countries around the world, they don't have it as good. And we really are the lucky country because we've got a lot of smart people here doing some really good things. Look at France, for example. Over 1 million people protesting in the street because they're changing retirement age and the contribution age, the time of contributions to be able to get the pension there. Our government was smart enough to, back a while ago, to sort of look at this and say, hey, let's create mandatory superannuation. So really lucky. And yeah, we are. I would love to be in that top spot. And maybe if enough people listen to this and it gets a bit more traction, we can get up there.
Well, there you go. It's on you listening right now to do something. So with that in mind, give me an example of someone who has super versus someone who doesn't have super. Like, what's the comparison there? Yeah,
I think this is really... If you really stop and think about this example, I think it really highlights why you should care about your super. So let's take one person that has super, and let's just say they've got about 100,000 in there, right? And I looked at the average Melburnian. The average Melburnian earns about 87,000 a year. Let's say they're age 40, so they've just come out of their 30s. They're thinking, better start doing something. They've got their super, and it's ticking along, and they're getting their mandatory contributions. When they turn 65 and they stop working, okay, they're going to be able to maintain their income till at least 73, 74. Okay. So currently, if you're on the average salary of 87,000, you're earning 5,500 roughly per month after tax. You're going to be able to maintain that all the way through to 73, 74 after you retire. And then it drops to about half. Now, the opposite to that is you drop to half of what you're earning, about 2,600 from age 65 all the way through retirement. So I'm sure if I said to you, hey, do you want to take half your salary now? The answer is probably going to be no. So it really can help for the long term.
And I know for myself, I saving money and me are not friends.
Well, that's the other good thing. It's a forced savings plan. So, your employer's putting money on your behalf. You can also add money to super if you want to, and I'm happy to go into a bit more details about that, but you can actually add to your superannuation as well. So it's a forced savings plan. It sits aside for your retirement. It's really good. And it's really, you can't pull it out and use it on those Black Friday sales, but it is there for the future.
You a Black Friday sale enjoyer?
Yes, I am.
Guilty as charged here as well. So you said that there's 2 different types of super there. So there's the employee contribution one. That happens automatically, but you can also add your own.
Yeah, definitely. So we have a cap. Currently, our cap is 27,500. So remember I said that you get a tax discount for using super. It's a tax at a favourable tax rate. So the government doesn't want you putting all your money in there because it's, a lot of lost tax dollars. So currently at the moment, you can put in up to 27,500
per annum.
Per annum. But included in that is what your employer puts in. Okay.
Oh, so you kind of top it up.
You can top it up to that 27,500. So for the self-employed, they're the ones doing it. But for the other people that are on a salary, they need to look at what their employers put in. And you get a tax deduction for any money you've put in personally and claimed. So if you are someone that's earning $100,000 and you put $10,000 into super, you're only taxed on the $90,000 in your hand. And that means that when you lodge your tax return effectively, you should get about $3,200 back in your hand. That's pretty good.
That's not bad. I'll take that. Now, you mentioned earlier that it was your biggest asset potentially. When you look at the average kind of home versus super and then some of the other assets that you might have, like I had not realized just how significant super is size-wise compared to, the car that I drive. It's not an amazing car, but it's my car. It's my baby,
Well, the average person in their 30s has over 100,000 in super. over $100,000 in their superannuation fund. It's something we should really think about. I mean, I'm sure if you drove a $100,000 car around, you'd not park it near the shopping cart trolley return bay, right? You'd park it somewhere safe.
That's why I get such a good car park spot at the shopping centre, okay? It's always right near where, because no one else parks there. All right, so that's tip number one, is that you've got to treat this asset like it is the biggest asset that you're going to have, because it is. You really need to focus on it. So for number two, you said that really it's your money but taxed differently. What do you mean by that? Talk me through that.
Yeah, so tip number two really is it can help you reduce your tax, okay? And I said to you before, the government gives you favourable tax rate for saving for your retirement. So part of that deal is if you put money aside, it's taxed at a lower rate, and you also get a tax discount. So I think I gave you the example before of someone earning $100,000, they put $10,000 into their super fund, they only get taxed on the $90,000 when they do their tax return. So a lot of people get confused about how we're taxed. So maybe I'll just explain it, because
yeah, please.
I always get a lot of questions about this.
And from the start, so I can take notes.
Okay.
Thank you.
All right, here we go. So the way marginal tax rates work, right, is your first $18,200 that you earn is tax-free, and then it scales up, right? Mm-hmm. It goes to 19%, 32.5%, 37%, 45%, right?
Based on like the more money that you make, the more you get taxed.
Yeah, exactly. And all you're doing when you lodge your tax return is that's just the point in time to go, hey, for that year, this is all the money I earned. And the tax office, you got to work it out yourself before you lodge it to the tax office. So this is all the money I earned. This is how much tax I should pay. And then the tax office looks at it and goes, yeah, you're right, or no, you're wrong. You owe us, or we owe you, right? So it's just a check and balance. That's all it is. So often when you hear people say, oh, I got a second job, but all of it goes to tax, so it's not worth doing. That's not really true, because you kind of work it all out on the back end, right? So it's just scaled and percentages of what you make. So why that's important to understand is going back to sort of putting money into super. So let's just say you earn $100,000, you put $10,000 in, only $90,000 gets taxed. What that means, though, is you put $10,000 into your super, and when you go to lodge your tax return, you're going to get around $3,000 back.
Great.
So not bad.
Yeah, I'll take $3,000.
And that goes to your long-term savings plan, right? Now, that's one way it can help you save tax. The other way is this, and I find this time and time again with people that come in and see me. Where you invest your money and how you invest your money is really important. It's a really important decision to make as to where you're going to invest your money. Now, remember how I said you lodge your tax return, and at the end of the year, the tax office looks at it and goes, you owe us money, don't owe us money. If I buy a share in your name, and that's just a share of a company, for example, let's take Woolies, for example, or Coles, right? You buy a share in Woolies or Coles, and you're paid $100 in dividend, okay? And that's just a share of the profit they made, okay? Everyone starts using their self-checkouts right, and they make a bigger profit, so you get a nice payout, right? Probably not everyone's favorite thing, right? But automatically, that $100, when you receive that, when you go to lodge your tax return, about $32, $37 is going to go straight to the tax office. If we had bought that in your super fund, only $15 would go. So less than half straight away in tax. And if you think about that over 30, 40 years of your lifetime, that's massive. That's a massive amount of money that could be in your hands, right? And helping you for your retirement. So really important to understand that not only does it help you with tax in terms of you put money in, you can get tax back, but also what it earns is taxed at a lower rate. So if I buy, and this comes to investment properties, shares, all these things, bank interest, anything like that, it's a lower rate of tax in your super fund. So if you don't need that money now, superannuation is a really good tool to look at.
Works well in the future. So yes. Tip number one, Maz, was focus on your super being, your biggest asset. And number two was using it to help reduce the amount of tax you pay. For number three, you touched on it very, very early on. And I just want to go on there because it's the big thing that everyone's talking about, housing affordability. Everyone would love to buy a house, but it just seems so unlikely, right? But it can actually help you to buy your first home.
Definitely can. So I gave that example before about, someone earning $100,000 and putting $10,000 into super. Mm-hmm. Generally, the response I get is a blank face and a look at me because they've just told me they want to buy their first home and they're trying to save. So why would I want to put $10,000 into my super fund? Well, luckily enough, you can actually use your superannuation to help you buy your first home. Now, you can't draw out on the current balance, but you can add to it and pull that out to buy his first home. Okay. Now, there's a lot of rules around this, so I strongly recommend sort of looking into it and getting some advice around there. But if you're over the age of 18, you've never owned a house in Australia, you can use your super to buy your home. Now, I've done some calcs around it, and basically, if you use your super to save, and you can put up to $50,000 in there, okay? So you can put $15,000 a year in, up to a maximum amount of 50, okay? So it takes you roughly 4 or 5 years to hit that mark. So you could use your super for that. You're going to be around $19,000 better off by doing that when you compare that to just saving through your bank. Now take a couple, that's nearly $40,000 better. Okay, that's maybe a 3-bedroom apartment or a 2-bedroom rather than a 1-bedroom, right?
Or the nicer part of town.
Yeah,
let's be
right.
real.
Yeah.
So what are those rules? So you have to be over 18. You have to be a first home buyer. So you kind of owned a house before. It seems fairly obvious.
Yeah. So you intend to occupy the property as soon as practical after buying it for at least 6 months in the first 12. You have not previously used this system before. And you've got to apply for your determination. So you've got to get it, the release authority before you sign your contract, right? Again, you can only put $15,000 a year in, up to a maximum of 50. But just going back one step, I have actually helped a client that has had a property in the country, in Australia, use this system, and it really helped from a tax rate. So if you've gone through financial hardship, that is, you can make a request to the ATO and send them a letter basically and ask for the ability to use this system. And I mean, for something that's worth nearly $20,000, it's worth doing.
It's worth a letter.
Yeah.
We're chatting with Maz from BG Private, who's helping us work out and come to terms with, your super and how you can make the most out of it. So we've had 3 tips so far. Focus on your super being your biggest asset. Use it to help reduce the tax you pay. You can use it to help you buy a house. Number 4 is really about kind of the quality of life that you live after you retire, right?
Definitely. I think that, this is what superannuation is created for. So it can help you buy your first home. Yes, it can help you save tax, but truly what the system's created for is to help you fund your retirement. I think in this tip, it's really important to sort of think about or talk about goals and objectives. I think this is something that I, as a financial advisor, it's probably the most important conversation I have with people. So it's going to fund your retirement, right? I think a lot of people walk in and they say, oh, Maz, we want to buy an investment property, or want to do this, or we want to do that. And I kind of always look at them and think you're kind of putting the cart before the horse. And I don't know if many of the listeners have heard that saying, but they're focused, so hyper-focused on the solution. They sort of forget about the problem. It's like, oh, I need to buy an investment property. So what I first like to do is sit down and say, hey, let's work out what your goals and objectives are. What are you truly trying to achieve? Because they'll walk in and they'll say, hey, Maz, I want to buy this investment property. And I say, why? And they look at me funny and they say, to make money. And I say, why? And they look at me even with a worse look, right? So why are you trying to make money? What are you trying to achieve, right? Because once you have those goals and objectives, you can understand how you can best set yourself up to achieve that. So if you've got a long-term goal, and this is what I call retirement. My definition of retirement is the opportunity to slow down from work on my terms. That's I reckon, personally, the best goal, right? So if that is your goal, then you can work backwards and say, okay, well, how can I do that? And what's the most effective tool to use? Because all superannuation is, to me as a financial advisor, is a tool. All an investment property or a share is a tool. So it's about what tools can we use and apply them to my situation to give me the best outcome or the best chance at getting that outcome.
And so the super is itself one of those tools.
Exactly. And that's how we got to look at it, right? It's a tool. It gives us a favorable tax rate. We can invest in lots of different cool things to make us money over the long term. It's nothing scary. That's the biggest point, right? It's nothing scary. It helps fund our retirement. And again, I think people get hyper-focused on the solution or the potential solution. They don't really look at the problem and working back, is that the best solution? They push everything out.
All right, so I know we're not doing individual, you don't know my situation, you haven't looked at any of the details in the background, but how much super do I need to retire? What's the amount? Is there a magic figure? How do I figure it out?
It depends on the person, right? And that's, yeah.
We've been through that. I know it depends on the person, but come on.
I'll give you the answer and you won't like it. But I will say this is a shoot for the stars and hope to hit the moon type of scenario. But if you had 1.6 million in super when you retire, that's a really nice number. And that seems far-fetched, right? But let's say you only get to $1 million. That's still really, really good, right? So the aim is as much as you can get. Now, there is studies out there that show that, you can get away with 600,000 in retirement in super, which is quite good. But personally, when I'm sitting down talking to my clients, I'm saying we need to get at least over $1 million in there. That's what we need to do. We need to aim to do that. And it is achievable, especially if you're talking to a 30-year-old. There's no reason why, and especially a professional or someone, a high-income earner, there's no reason why you shouldn't hit that 1.6 million. You got to get there, because that means that you're going to retire. You're going to live off the income the super is creating and not touch the capital. And it's going to be there for the rest of your life, right?
Say that again. Live off the
income it creates.
Talk me through that. How's that work?
So again, superannuation is nothing magical. All it is just a structure where it's taxed differently. In there, you have generally what we have is shares. We usually have property, we have fixed interest, and I can explain that, and we have cash, okay? All they are is investments, and they're earning a return, right? And there's two types of return, and I liken it, I'll give the example of a house. You buy a house for 100, this is Melbourne, so you buy a house for $1 million, and next year it's worth 1.1 million. That is called the growth return. But let's just say in that year you rented it out and it gave you, 30,000 of rent, making it up. That's your income return. So you have your growth return and your income return. Let's just say in that same example, the house fell to 900,000 instead of going up to 1.1 million. Your growth return went down, but you still got the rent. Okay, so there's two different types of return your super can have. So if you have a big enough balance when you retire, effectively you can use that to fund your day-to-day living costs, and you never actually have to sell the house.
Right.
Because once you sell that house and you spend that capital, and call that capital, that's a fancy word for the money you started with or the initial input. Once you spend that, it's gone. It's not coming back, right? It's in someone else's hands. So if you can get it high enough, you can use that income return, and that's really powerful. And I've seen some, I've sat in front of clients in their late 80s, early 90s, and they had $3,000 more balance. So they started off with 880,000. I'll never forget this lady. She had 880,000 when she retired, and she retired when she was in her late 50s. And I was sitting in front of her. She was 88, and she had $883,000. And she'd been drawing an income every year, and it was around 60, 70,000 a year. She'd been drawing that income, and she was happy and
just living out her life.
And she still had that money in there.
It's beautiful.
Yeah.
All right. So that's tip number 4, is that it helps you live the way that you want to live. And obviously it sounds like she's living, just the perfect little life there for herself, not having to think about where that money is coming from. Have you got any other examples?
Yeah, so I've got plenty. I've got lots and lots of different examples. Maybe if I go through a case study, because I think I just want to go back and highlight why goals and objectives are so important and understanding what you want to achieve, and how when you focus on one solution, you can miss others that might be better for you. So often I get the question is, hey, should I pay off my home or should I put money into super? That's sort of one. So I want to pay off my home loan faster. What should I do? So I can run through an example, right? You got a $650,000 loan. You got 30 years to pay it off. Option 1 is you're going to take $2,000, okay? And after tax, you're going to use that money to pay down your loan. Okay? Excellent strategy. You'll see your loan paid down in 12 years and save $243,000 in interest.
Yeah, because the interest is the killer there, right?
Yeah.
That's how they're making a lot of it back, right?
And I think it's really interesting, I think, on that interest point, right? You got to remember the bank's looking at your loan every day. And every day they're working out the interest. They're applying that per annum interest rate, but then it works out to a daily figure, right? And then it gets charged to your account usually on a monthly basis. So the more money in that loan, the more interest you pay. So that's why paying down debt is such a powerful tool, and especially with interest rates where they are, we can feel it, right? And that's unfortunately what it's designed to do. So if you pay that loan down, you assign $2,000 of your pay to your home loan, you pay it down, you're going to pay it down in 12 years. But I'll give you an alternative. Let's just say you take that $2,000 and you put it into super. Okay, remember how I said you get those tax advantages?
Mm-hmm.
So
because they're taxed at the 15% rather than the 30%.
Yep.
Or whatever it is.
So effectively, you're actually assigning to your super around $2,400. So you're actually getting a lot more in there, right? So effectively, because you're getting a tax discount, you're getting taxed lower in your hand. You're going to pay off the home loan in 12 years, same as the other scenario, but left over, you're going to have $43,000. So how are you going to do that? You're going to put the money into your super fund, come to that 12-year point and go, okay, and obviously you've got to meet the conditions of release around this, so let's put that in there. But effectively, you're going to be able to pull the balance out, pay your home loan off.
What, in one fell swoop?
One fell swoop, and then have $43,000 left over. Both scenarios assume you made the minimum repayments, but pretty good.
That's broken my brain. I'm sorry. I don't know how I continue after that. Okay, so that is an incredible example. And we were talking about, how much super you need to retire on. And I guess my next question is, you listed 3 or 4 different assets that were in there, right? Diversification is a term that I have heard, and I know that it is a word that is in the English language. And I assume it means getting lots of different things, but I don't specifically know how that works in this context.
I'm certain that us in finance just give things fancy names to make ourselves feel better. So
it feels like that.
Don't worry. I did my master's and I came to the realization that, hey, all this stuff is pretty simple. It's just made to sound complex. So diversification is just the fancy word for not putting all your eggs in one basket. So maybe I'll spend some time running through, and this will probably run us through to tip 5, right? Mm-hmm. So you are an investor, and investors care about their investments, right? And your superannuation is one of your investments. And it's got all those things in there that we spoke about before, and maybe I'll run through them now. So diversification, fancy word for spreading out all your eggs, right? Not putting them all into the one basket. Why do we diversify? It helps spread our risk. The opposite to diversification is concentration. Concentration is where you buy one thing and you cross your fingers and your toes and you hope it goes really well, because if it goes really well, you do really well. If it goes really bad, you do really badly, okay? And so you got concentration on one side, or concentration risk, and then you got diversification as sort of the alternative, right? Diversification is great and it helps spread our risk, but over diversification, so too much, putting your eggs out too far, has a risk of lowering your returns. Because let's just say you've got one thing in there, you might have an Australian share in there that did really, really well. You've only assigned a little bit of money to it compared to if you concentrated into that. So you've got to try and find that balance.
So is there like an ideal number of things that you should diversify into?
I wish I had the answer for you there. But what I can say is the younger you are, the more ability you have to have a little bit more concentration and have a lot more growth. So have high growth and be concentrated into those things that are really volatile. Another fancy word, right? And that's just the word for the ups and downs, go through those ups and downs. But you can afford to have a little bit more concentration and sort of have that risk in there. I would say that anyone's portfolio, you should have Australian shares, international shares, and that's just anything outside of Australia. Probably US would be one big part of that as well. Fixed interest. Now that's just all that is loans to big companies or governments. That's all that is. And a little bit of cash, right? Now, the younger you are, the more in the top two you want to have. And I missed property, the biggest one.
Oh, yeah.
So how do I forget that one? Property, shares, then you got fixed interest and cash. So the younger you are, the more you want to have in shares and property. And the older you are, the more you kind of want to have in those lower risk assets. So that's really important. So you've got, maybe I'll sit and run through a couple of the different assets that we have. So you've got shares. Now these, some people get confused and sort of don't really understand what they are or how they work, but all they are is you're buying a share of a company. So you go out today, you go, hey, these banks are making a lot of money. I'm going to buy a share of the Commonwealth Bank. When the Commonwealth Bank makes profit, they then give what we call dividends. That's just a share of the profit coming out to you because you're the owner. There's two types of returns. Like I said before, there's that income return, which is a dividend that comes through, and then there's a growth return. The Commonwealth Bank share goes from $100 to $101. You made that $1. So that's shares. You're just owning a share of a company. You have property. So there's residential property, places that people live in. You have commercial properties where, places like this rent out of or, and pay their rent. And then you have fixed interest. So fixed interest bonds in particular. The easiest way to explain this is, let's just say the local council here wants to build a pool, and they don't want to use the money they've got saved up. They want to go out and get a loan. So what they do is, rather than going to a bank, they just say, hey, listen, we're gonna offer a loan, and you can buy chunks of $10,000 in this loan. So if you buy a $10,000 chunk, you give us $10,000, we're going to give you 6%, okay, for 10 years. And then at the end of the 10 years, we'll give you back the $10,000. So you've collected your 6% all the way along the way, and it's a fixed interest rate, and that's why we call it fixed interest. Mm-hmm. So property, shares, fixed interest, cash, they're the main investments. And then obviously there's people that like to go into other things like cryptocurrency and all those different things, but they're the main ones you have. Another key question I get on that is should I be buying crypto or should I be looking at that? I think a really important point in there is I don't provide advice on that, but what I say is that if you're going to invest and you're going to have an investment portfolio, I liken it to building a home. The first thing you do when you build a home is you set the foundation. You put the frame up and you build that nice home. You don't go, I'm going to build a home and go and buy that fancy letterbox and put it at the front before the home's even built, right? You want to have a nice diversified portfolio. So the foundation is that nice diversified portfolio. Once you've got that and you've got all the rooms in there and the framing up, you can start to add things, okay? Because you've got that foundation set. You've got that home ready. But if you're just going out and buying those fancy things, yeah, it might come off good, but you don't have that base yet set up. So that base is really important to go.
And so crypto is the fancy letterbox? Is that what you're saying?
Oh, something like that, I would say.
Okay, that makes sense. Now, in terms of the kind of different things that you can, buy shares of or get fixed interest in, you said it was all about risk, right? Like how much risk can you be involved in without it being like I'm quite risk averse. I don't want to take too many risks, but you kind of have to play the game, right?
Yeah, I think you got to look at long rates of return. So in the last 30 years, Australian shares have given us 9% per annum. Mm-hmm. You look at currently what we get in term deposits, it's around 5%. Extrapolate that 4% difference over 30 years, that's a big lost opportunity cost. Your superannuation is going to be there until you're not going to be able to draw on it until you're at least 60 or 65. Mm-hmm. You got a really long time horizon. And if we were on the screen, I'd show you an index chart and show you the long-term sort of growth rates. But we know that growth investments, shares and property have grown over the long term. That's why we give them that name. So in your super, you can afford to take more risk the younger you are because you've got that really long time horizon. The market's volatile. It's going up and down, but you don't care about that because you remember your employer's putting money in. So you're actually effectively buying. You want some drops in there because when it drops, that money's going in, it's buying at the lower point. It's just like when you go to Coles or Woolies and you see that yellow ticket saying half price, you're going to buy more of it. And that's effectively what you want to do in your investments. And that's effectively what your super's doing, because your employer's putting money in. Now, you can be putting money in as well, and then it's buying at those dips as well. So over the long term, you're getting that nice return. So effectively, you've got a long time horizon. You can afford to take that risk in there.
Now, with the super fund that I have, every time they send out like a mail and it's like, here's how it's done, right? They also then add like, and here is your insurance detail. Like, here's how much insurance you have and here's what you're insured for. And it's not normally something that I think about, but that can kind of help, I mean, if anything goes wrong, right?
Yeah, definitely. This is something that people often miss. Now, this is definitely not a fun topic, but it's an important topic. So insurance is something that most people have in their superannuation. And I think maybe if I spend a second just to explain what type of insurances there are, and sort of that might sort of help to understand what's coming out. So the easiest one to explain and unfortunately I might sound a bit morbid, but the easiest one to explain is death or life cover, we call it. If you pass away, a lump sum is paid out to your family, or to your super fund in this instance. Then you have TPD, or total permanent disability insurance. Basically, that insurance is 2 doctors agree that you can never work again, lump sum is paid out to you. Okay? Now, you got to think, when you're young, you actually need quite a lot of total permanent disability insurance. So, often you see people move their supers and not really think about it or look into it. If that super had a better total permanent disability cover and something happens, unfortunately, then you've lost that cover. So you really want to look at it. So total permanent disability, 2 doctors agree can never work again, lump sum. Then you have income protection. Okay, so income protection is just you can't work for more than, let's say, 30 days is the average. There's all different wait periods, but you got to wait your wait period, just like your private health cover. Mm-hmm. You wait your wait period, and then if you can't work, they'll pay out for a set period of time. So they'll pay you 70 to 75% of your monthly income that you're earning. They'll pay that out monthly for, some of them are for 2 years, some are for 5 years, some are to age 65. Everyone's different, so you've got to have a look at your superannuation and sort of what your insurance is. Now, I think that's a really important point, because most superannuations have insurance, and most of us are paying for our insurance through our super. But I think one thing that people don't look at is your income protection is one thing that's actually tax deductible in your name. So remember how I said superannuation is paying a flat rate of 15%?
Yeah.
And then let's just go back to, you have your marginal rates, and I said that they were, there was 0, 19, 32, 37.
Yeah.
I reckon the average person sits around the 32 and 37 rate, right, on average. So if you're paying for your income protection in super, your super fund's getting a 15% discount on what it pays, because it's a deduction, basically. Mm-hmm. If you were paying for that income protection out of pocket, you would get 32, 37% back.
Oh, okay.
So looking at what insurance we hold and where we're paying and how we're paying for it is a really important factor, because insurance is there to cover, right, if something goes wrong. And begrudgingly, I have my insurance, and every year the renewal rolls around and I'm not happy, but I still pay it because I know I need it, right? And that's me, a financial advisor. But it is something we need. So what we do is we look at, well, okay, where are we holding our insurance? And am I getting the biggest bang for buck? So just by moving your insurance to outside super, for example, you're going to get a better policy usually, and you will save more tax. Because again, superannuation is just your money taxed differently. So when you take it through that lens, you want to look after it.
Okay, so all this information about diversification and insurance info, is that something that I can change? I can go to my super place and be like, hey, do this instead? Is that a thing that you can do, or is that something that they decide?
So generally what happens is when you put money, or when your superannuation is set up, you go into what you call a default option. If you want to go in, most super funds are really good now in terms of having an online login. You can log in, you can change your investments, you can look at what your returns were, you can look at your insurance that you covered for, you can look at what's come into the fund and gone out of the fund. So you can go in there and you can get right down to the detail and change where your investments are. Look, most of the big funds, it's kind of, they've got these set options, growth, high growth, balance. So you can sort of change that without too much problems. But I would sort of look at it and go, okay, maybe you do need to seek advice when doing that, but you can definitely jump in. You can log in online. You can call them up. And you can do all that. And some of the logins are really good now in terms of what you can see and how easy it is to change. But again, I think the younger you are, the more ability you have to be able to go into those higher growth options and sort of go and have a look at the long-term growth numbers and say, oh, okay, this is what this option has returned versus this option over the long term. Maybe that might be better for me. So having a look at that.
And as you were saying, like if you get more at a younger age, you then I guess have more to play with to be able to reapportion in a safer way later on. Exactly.
And that's the aim of the game. The aim of the game is to, when you get to that older point, have as much accumulated in there as you possibly can. So that's why superannuation is really, really good, And I know a lot of people don't like listening to me when I talk about it, but they don't get excited initially. But it is something that really, really is important because, it can help you save for your first home. It will fund your retirement when you're older. And, time and time again, there's case studies that can show that, how effective it is in terms of saving tax. It saves you tax now and in the future on earnings. So really important tool.
All right, so I'm with one of the bigger super funds.
Yeah.
How do I, if I click the login and I go in and I see what they're doing, is there a way for me to go, actually, I don't like what you're doing and I want to go to this other super fund? Is that like a thing that is easy to do?
Really, really easy to do. So, what's really cool now is the ATO, if you log into your MyGov, you can actually see all the super funds that you have. So they should be reporting into MyGov, into the ATO portal, and then you can actually see them. It's really easy to do. A lot of super funds can actually handle the rollover, we call it. So you're with one super fund A and you want to go super fund B, you would go to super fund B, set up an account, you can call them, they can help you with it, and they'll do a rollover. Just remember, when you're doing that rollover, you're going to lose all the benefits and features of your last fund, so your insurance goes and all those different things. So make sure you check through it and look through it properly and maybe seek some advice, but definitely you can change it over. It's a really effective, cool thing to do. If you've got a super fund that's got a balance of under 6,000, okay, and you're not putting money into it, the ATO will actually pull it from that fund, hold it, and then push it to your active fund.
Okay.
So let's say your employer's putting money into one fund and you had some fund you forgot about all these years ago, the ATO will pull it and push it into your new fund. So
it's a good way to make sure that there's no kind of accounts that you've forgotten about and out of sight, out of mind, and they're just sitting there doing their own little thing. And when you log in, can you get to decide, when you die, who gets your super? What happens when you die? Does it just stay there? Do you get to tell people, hey, it goes to your super now?
Yes, that's a really good question, actually. Yes, the answer is yes. So you can go in there and you can put who you want your superannuation to go to if you do pass away, and hope that's not for a very long time.
Thank you.
That's okay. But what's really important to understand is there's different ways you can tell the super fund where you want it to go. So if you're just logging in and you put it in there, that's what we would call a non-binding nomination. So there's not binding on the super fund. They will take it into consideration, but they do not have to follow it.
Right.
Yeah. So really important. Maybe if I might explain for a second how estates work. So this is all your stuff when you pass away, what happens. So superannuation doesn't actually form part of your estate. And your estate is just all your stuff that you own in your name. And, it's decided where that goes by your will. Now, if you don't have a will, there's a process that's run through. But basically, if you have a will in place, and I'd strongly recommend anyone that doesn't, go and see a lawyer that specialises in that and get a will. But when you pass away, you have what you call your estate, and that's everything you own in your name goes. Your superannuation fund does not form part of your estate. So you have to tell your super fund where you want it to go. You can make a nomination, and it can either be binding or non-binding. Okay, so non-binding, it's not binding on them. You can get forms from your super fund, and most super funds, if they offer what they call a binding death nomination, you get some forms, you fill them out, you tell them where you want it to go, and they'll generally have information on there of what's a valid nomination, because there's some laws around who can actually get your super. So generally you have to have it can be a spouse, an interdependent financial relationship, children, those type of people can get it. So a lot of people I'll see, they'll have their brother or sister on there. That might be a non-valid nomination. So you put on this form who you want to get it. You can put your estate down, so it can go into your estate and then be divided as per your will. You have to get 2 witnesses to witness your signature. So, if we were sitting here doing yours, I could witness and someone else could witness alongside. But that witnessed binding death nomination goes to the super fund, and that is binding on them. Now, to further complicate things, it can be lapsing or non-lapsing. Lapsing means that you need to redo it every 3 years. Non-lapsing means it stays in place forever. But it can be made invalid by certain events in your life. Okay, so really,
certain events?
Yeah, like divorce can be one, those type of things, right? So the biggest thing there is just to understand it's not part of your estate. You should nominate where you want it to go. If you want it to go to somewhere where it's not listed, and read the forms, like the forms will tell you what's valid, what's not valid, then you might consider going to your estate, right, and putting that down, and then having a will in place. So making sure that you have a will. I really recommend that, if you have a financial advisor, this is something we review every year, but you really need to be talking to those professionals, especially around your life events, and that's an estate planning solicitor. Especially if you go through a breakup or even a de facto. It doesn't have to be a divorce. It can be a de facto relationship, living with a partner for more, for a while. You really want to review where your super is left to and make sure that nomination is up to date. And it might even be something that, kids help their parents check, because, I did tell you that superannuation is going to be your biggest asset. We're not far off what is going to be the biggest wealth transfer in history, and that is the biggest amount of money passing down to the next generation. So helping the family understand where, if their estate planning matters are sorted, and that is their superannuation is one of them, they should have a look at, is really important. So that's something you can check. You generally can check it online or give them a call and they'll tell you how to check it.
And so what about if the super gets left to you?
Oh, that's a great question. So if it gets left to you, this is a big topic.
Sorry, do we have time for this?
I don't know. Well, we can go through. So if it comes to you, so let's just simplify it down. If it comes to you, then it'll get paid out to you. So it doesn't just transfer over to your super fund. You get paid out the amount. There is some tax implications around that, but the super fund will generally withhold the tax they need to when it gets paid out. If it's your spouse's super, there's no tax implications and those type of things. But generally, it's case by case. But when you get paid out, you get the money and then off you go and decide what you want to do. And I think, if you do get a large amount from any time you get a large amount of money, I think that's a perfect time to sort of speak to an advisor, because that's when you really want to say, okay, well, what do I do with this money? Because it might be beneficial for you to add to your super or not add to your super or pay down your debt or do something. So, yeah. I think maybe I should answer a question that I often get. This might help the listeners, because maybe understanding the different types of super funds might sort of help to understand, because industry funds or your big super funds are just one option out there.
And honestly, I'm only with one of the big ones because that was one of the default options. They were like, well, you can have one of these ones. And I went, sure, that one. That'll do.
That I'll take that one.
Or that one.
I love that show. So you've got the industry funds, right? And they've done a great job over the years of helping to lower fees over the industry, right? And they do a really good marketing campaign in terms of what they can do. In my opinion, set up to really focus on that lowering fees. So what they do is they try and achieve economies of scale. So remember the old Henry Ford adage, you can have any color you want as long as it's black. So
yes.
it's a little bit limited in what you can have, but for a reason, right? It helps them keep the fees lower. So you get a call center and all those different things. So they're your industry funds. You have your retail funds, which were given a bad rap in the past, and I can see why, because they were quite cost prohibitive, but they usually do have a few more features and functions that you don't get through your other funds. So for those higher balances that need a little bit more complexity because of certain strategies that you can do, you sort of look at maybe your retail funds, because they've got some sort of different options, right? Or some different functions and features that you just can't get through industry funds. Then on the other side of that, the funds that can really house complex investments and do all sorts of different things that the other ones can't, you have your self-managed super funds. The devil's in the details in the name there, right? You are self-managing your superannuation. So all the risk and liability falls on you as the manager of your superannuation fund. You need to make sure that it fits and meets the legislation requirements. So it takes a lot more effort. It actually costs a lot more money, right? But it can do things that other superannuation can't. For example, you can have property within your self-managed super fund, right? There's lots of rules around that, and it can be more expensive, but it's just another option, another tool you can use. So your industry funds, your retail funds, and your self-managed super funds are the three main ones we have.
Before we wrap this up, maybe let's recap those kind of big 5 points that you've been hitting across this whole episode, because I know I've been sitting here taking notes. I don't think I've got them all. So number 1 was that it's going to be the biggest asset that you have after your home, your super?
Yeah, that was number 1. So it's going to be one of the biggest assets that you hold. It can be next biggest to your home, or for some people it might be bigger if they don't have a home. It can be a tool that you use. I've got clients that don't actually want to buy a home. They travel, they move for work and all these different things. They don't want to be locked down to a certain location. Superannuation can be that investment that looks after you in the long term. So it's going to be your biggest asset. It's going to be one of your biggest assets at least. It should be, your number one. You should be top of mind.
Okay, so focus on it because it's your biggest asset is tip number 1.
Yeah.
What was tip number 2?
Tip number 2 is it can reduce the tax that you pay. So both now and into the future, superannuation is taxed at a lower rate. When you put money in, you're given a tax deduction. I gave that example around the $10,000. So you put $10,000 in, you're earning around $100,000. You're going to get around $3,000 back in your hand. Not only that, the income it earns or anything it generates in the super fund is only taxed at a flat rate of 15% compared to you, where average marginal tax rate's around 30%. So saving half in tax. So that's tip number 2. It can help you save tax. Tip number 3 was it can help you buy your first home. So we got the First Home Super Saver Scheme. So you can put up to $15,000 a year to a maximum of $50,000 and use that money to buy your first home. You just have to be over the age of 18, never owned a property in Australia, intend to live in it for the first 6 out of the 12 months that you own it, or as reasonably practical after buying it. You've not used the program before. You can't take out any of the other money in super, so it has to be money that you put in. That's a really important point. And you have to apply for the authority to take out before you sign the contract to buy the home. And tip number 4 is it funds your retirement so you can live the way you want to. And that's where we spoke about goals and objectives and sort of really understanding what you're trying to achieve. And I gave that comparison around putting money into super versus paying off your home loan, which are both great strategies, but it's just which one's going to suit you better. And tip number 5 is, whether you like it or not, and you should like it, you are an investor and investors care about their investments. So you should care about your super. You should really take an active interest. And, in there we segued and talk about insurance and diversification and how investments work. But tip number 5 is, they are your investments. They're yours. Your money taxed differently. So you should take an active interest in it. So there are 5 tips.
Well, that's all incredibly helpful advice. And I know for someone like me who, as I say, I have a super account, but I'm not totally aware of how it works, it's really helped explain how doing it now helps for the long run to make it a whole lot easier into the future. But also, it's made it really clear that we haven't even been talking on a personal level for me, and I feel like you've been talking personally into my life, right? But you really should go and actually talk to someone about it rather than taking all of your advice from a podcast, right?
I definitely recommend seeking advice from a financial advisor. And I know that's kind of I have a bias because I'm a financial advisor. But if I'm going to say that, I should say what you should look for in a financial advisor.
Yeah, absolutely.
So do your research, find someone that you think you can be comfortable with. That's my biggest tip, right, is find someone that you're comfortable with. Go out, meet a few different advisors, ask them for if they can give you case studies, ask them for what their average client looks like, ask them their fee structuring, how they charge. For example, our firm, we're very open in the way we charge, very transparent. We explain we won't charge a fee until you've agreed to it in writing, and we explain exactly what we're doing, and it's all broken down for fee. So you can ask that. Don't be scared to ask, how do you charge and why? And my thing on fees is don't be afraid of paying fees. It's more of what value am I getting from this? Am I getting value from paying this fee? People value different things. So if you're getting value out of it, then it's a good thing. If you're not, then don't use it. Make sure, and sorry, I should have led with this one, the most important one, make sure to search the financial advisor's name on the Money Smart ASIC register. So check they're a licensed and accredited financial advisor. And don't be afraid to ask them what their qualifications are. And their qualifications should be listed online on that Money Smart search. So strongly recommend you do that. ASIC Money Smart has a lot of good tips, a lot of good tools. So while you're on there, you can use a superannuation calculator. I love that tool. You can see, project out your super and what it might be. You can use the budgeting tool. You can search your financial advisor. It can help you with your tax, working out your tax. Whole bunch of things, and a lot of good articles there that you can read up on and have a look at. So strongly recommend you jump on that. But yeah, definitely seek advice. The point there was seek advice, a financial advisor, and make sure they're accredited and licensed.
Great. And so how do we do that? Like, you just Google for it?
Yeah. So ASIC, just Google ASIC Money Smart Financial Advisor Register. It'll come up, and then you put their name. So for example, you just jump in there, click, and you put my name, just put it in, and it'll come up with all my credentials and my license number and all those things, and it has my experience and everything on there. So yeah, anyone can do it. So and you can have a look. There's lots of different things. Look at reviews, just like you would. There's Google reviews. Be mindful that, reviews can be manipulated and changed. People can be angry for something that happened, or they could get their friends on there. So having a look, if you do all those things and interview a few, and then find if all those things check the box and you're comfortable with that person, then yeah, I think that's a good mix, right?
Well, this has been fantastic. Maz, thank you so much for coming in. I understand so much more of it now, so appreciate it. If people want to know more about BG Private, where can we go?
So definitely you can look online. So our website is bgprivate.com.au. You'll find our phone number, find our email. You're welcome to call us or email us. I'm always happy to have a chat. So if you want to give us a call, happy to sort of set a time aside. But jump online, have a look. We're on LinkedIn as well, and all those social media places. So quick Google and you should be able to find us.
Brilliant. Thank you. And of course, if you've enjoyed this podcast, if you've gotten something out of it, share it with your friends. Everyone should be benefiting from taking control of their super, and it could be you. You just grab it and hold on to it and it's yours. Thanks so much again, Maz. Appreciate it.
Thank you.
The information in this podcast contains general advice and is provided by BG Wealth Management, AFSL number 496348. That advice has been prepared without taking your personal objectives, financial situation, or needs into account. Before acting on this general advice, you should consider the appropriateness of it, having regard to your personal objectives, financial situations, and needs. You should obtain and read the product disclosure statement before making any decisions to acquire any financial product referred to in this podcast. Please refer to our financial services guide available at our website bgprivate.com.au for contact information and information about remuneration and associations with product issuers.